Most people believe they bought a house for the price written on the listing. If the home costs £400,000, then in their mind they bought a £400,000 house. But something interesting happens when you examine the numbers carefully. By the time the mortgage is finished, many homeowners may have paid closer to £800,000. Sometimes more. Not because the house doubled in price, but because of how mortgages are structured. And once you understand that structure, you begin to see mortgages very differently. Now, to be clear, this is not an argument against home ownership. For many families, owning a home is a meaningful and stabilizing decision. A home can provide security. It can create long-term stability. And in many cases, it becomes a valuable asset. But mortgages contain a financial structure that most people never examine closely. And that structure quietly determines how much your home really costs. Let us start with a simple example. Imagine a £400,000 home. You make a deposit, and the remaining amount is financed with a 30-year mortgage. Now assume the interest rate is around 6%. Nothing unusual here. This is a fairly typical structure. Your monthly payment might look manageable. Perhaps £2,200 or £2,300 per month depending on the exact loan. And this is where many people stop their analysis. They look at the monthly payment. They decide it fits their budget. And the mortgage feels reasonable. But something interesting happens when we zoom out. Instead of looking at the monthly payment, we look at the total amount paid over 30 years. When you add all the payments together, the total may reach £850,000 or more. That means the house did not cost £400,000. It cost more than double that amount. This is the hidden mathematics of long-term borrowing. Now here is where things become structurally interesting. Because mortgages do not just charge interest. They distribute interest in a very particular way. A structure known as amortisation. At the beginning of a mortgage, most of your payment is not reducing the loan. It is paying interest. In fact, during the early years, a surprisingly small portion of your payment actually reduces the balance. Pause for a moment and think about that. You may be making large monthly payments, but the loan itself may not be shrinking very quickly. This often surprises new homeowners. Let's imagine a simple illustration. Suppose your mortgage payment is £2,300 per month. In the early years of the loan, perhaps £1,900 of that payment is interest, and only £400 is reducing the principal. In other words, most of the payment is servicing the loan, not buying the house. Now here is the part most people miss. Because the mortgage balance declines slowly in the early years, interest continues accumulating on a relatively large amount, which means the lender earns the majority of their interest during the first half of the mortgage. This is why moving house or refinancing early in the mortgage cycle can feel frustrating. You may have been paying for years, yet the remaining balance still looks very large. But there is another layer to this story. And this is where mortgages become more interesting from a strategic perspective. Because although mortgages can be expensive, they also provide something very powerful. Leverage. Leverage simply means using borrowed money to control a larger asset. Let us return to the £400,000 home example. Perhaps you contributed a £40,000 deposit. That means you gained control of a £400,000 asset using only a fraction of the purchase price. The remaining amount was financed. Now imagine that property appreciates modestly over time. If the house increases in value to £600,000 over a couple of decades, the gain accrues to the homeowner, not to the bank. The bank receives interest, but the homeowner receives the asset growth. This is why mortgages can be both costly and powerful at the same time. But something even more interesting happens over long periods. Inflation gradually reduces the real burden of fixed debt. If your mortgage payment remains relatively stable, but wages rise slowly over time, the payment becomes easier to manage. 30 years from now, that same monthly payment may feel far smaller relative to income. Meanwhile, the property itself may have appreciated, and the debt balance will have declined. This combination is one reason home ownership has historically helped many households build wealth. However, this does not mean every mortgage decision automatically creates financial progress, because the outcome depends heavily on how the mortgage fits within your broader financial structure. For example, a mortgage that consumes too much of household income can limit financial flexibility. If nearly all disposable income goes toward housing, there may be little left to invest. And investing is another powerful engine of long-term wealth. So mortgages should always be evaluated within the wider context of capital allocation. Pause for a moment and consider this question. Is your mortgage simply a monthly obligation? Or is it part of a larger financial strategy? For some households, a mortgage represents stability. For others, it represents leverage within a broader investment strategy. And for some, it can become an overwhelming financial commitment. The difference is rarely the mortgage itself. The difference is the structure surrounding it. Now there is another concept worth understanding. Opportunity cost. Every pound directed toward one purpose cannot be used elsewhere. For example, some homeowners choose to aggressively pay down their mortgage early. This reduces interest costs and eliminates debt sooner. Other homeowners prefer a different strategy. They maintain the mortgage and invest excess capital into assets such as equities or businesses. Both approaches have merit, but they produce very different financial trajectories. This is why mortgages are not simply about borrowing. They are about capital allocation decisions over time. How much goes toward housing? How much goes toward investments? And how much remains for lifestyle? Now let us step back and recap the key idea. Most people think about mortgages only in terms of monthly affordability. But the true cost of a mortgage is revealed when you examine three things: total interest paid, the structure of amortisation, and the long-term role of leverage. When viewed through that lens, the mortgage becomes more than just a payment. It becomes a long-term financial structure. Understanding this structure does not mean you should avoid mortgages. It simply means you approach them with greater awareness. You understand the mathematics. You recognize the trade-offs. And you make decisions intentionally rather than automatically. Because the goal is not simply to buy a home. The goal is to build a stable financial life around that decision. Once you understand how mortgages actually work, you stop seeing them as simple monthly payments. You begin seeing them as long-term financial architecture. And financial architecture always rewards those who understand the structure. If this changed how you think about mortgages, comment structure. And if you enjoy calm, thoughtful discussions about financial systems and wealth design, consider subscribing. I will see you in the next one.